10 million barrels of oil vanished in 30 days, and silver just violently decoupled from gold. The 2026 macro crisis is here, and your portfolio is tracking the wrong data.
10.1 million. That number represents the absolutely catastrophic drop in global daily oil supply following the recent geopolitical escalations in the Middle East. We're talking about a massive systemic shock here, one that's literally rewriting the rules of global finance as we speak. Because while Wall Street cheers the AI supercycle, the physical foundation of the global economy, maritime logistics and critical minerals, is fracturing right beneath our feet. We're witnessing a historic transition, moving away from efficiency-based globalization straight into a highly fragmented, security-first world.
Today, we expose the exact data institutional money is hiding regarding the Trump Z Summit and the 866 million-ounce silver deficit. This is the hard reality of the physical market, a reality the paper market hasn't even fully priced in yet.
Section 1. The normalization trap. If you are holding traditional 60-40 index funds, you are standing directly on the tracks of the normalization trap. The old playbook is just dead. The previous era relied on stable inflation, open trade routes, and basically infinite cheap energy. And let's be real, absolutely none of those exist in 2026. Quick reminder before we get into the data, the following intelligence is for educational purposes only and does not constitute financial advice. Asset allocation carries inherent risk, especially in the highly volatile environment we're about to decode today.
Let's break down the macro-micro deviation. FactSet corporate earnings look bulletproof right now, but when you look at the global output PMI data, the margin for error is razor thin. Sure, we have resilient headline growth in places like the US and Asia, but look underneath the hood. European industrial output is completely stalling out, and global shipping is in absolute chaos.
Section 2. The energy rupture and the Strait of Hormuz crisis. Take a look at these numbers. That 10.1 million barrel drop in March, it completely dwarfs both the 1973 Arab oil embargo and the 1979 Iranian Revolution. We literally saw North Sea-dated crude violently spike to $130 a barrel. Refineries in Asia and the Middle East were so starved of feedstock, they were forced to cut runs by a staggering 6 million barrels per day. Even the World Bank confirms this is the largest oil market disruption in history. It's creating a physical shortage that goes way, way beyond mere price volatility. Think about it. This isn't just about paying more at the gas pump. Nearly 30% of global fertilizer inputs originate right there in the Gulf region. This rupture is directly impacting global food security, and it's sending shockwaves through literally every supply chain on Earth.
And this brings us to a really critical concept: the violent decoupling of the paper economy from the physical economy. You cannot print a barrel of oil, and you sure can't print an ounce of silver. When the physical world tightens up, the digital economy hits a massive brick wall.
Section 3. The silver decoupling and industrial deficits.
Okay, this is where it gets incredibly interesting. Silver has violently decoupled from its historical relationship with gold. Usually, during times of macro stress, capital flows uniformly right into precious metals. But back in May 2026, we saw silver surge over 6% in a single trading session. It outpaced gold by a factor of 16 and aggressively compressed the gold-silver ratio all the way down to 55. Why? Because while gold serves as a traditional monetary shield, silver is entirely constrained by its critical role in the electric stack. Roughly 60% of silver demand is purely industrial. It acts as the irreplaceable bridge connecting our physical and digital economies.
We are now entering the 6th consecutive year of silver deficits. Look at this data. A record 215 million-ounce shortfall is projected for 2026 alone. Mine supply has totally stagnated due to years of severe underinvestment, and recycling? It simply cannot cover a gap this massive.
So, what's the big takeaway here? The crucial point is that inelastic industrial demand from AI data centers, EVs, and solar panels is practically wiping out above-ground inventories. And this is exactly why stabilizing trade relations like what we saw at the recent Trump-Xi summit acts as a huge accelerant. It gives manufacturers the certainty they need to ramp up production, which, ironically, only drains those silver vaults even faster.
Quick pause here. If you want to survive the 2026 transition from fiat to hard assets, hit subscribe right now before we reveal the specific ETF action plan. We are mapping out the exact moves institutional capital is making to hedge against all this systemic fragility, and you definitely don't want to miss it.
Section 4. The Nearshoring Boom and Mexico's Industrial Map.
As the old world energy lanes permanently close, a completely new industrial map is being drawn at lightning speed. The smart money is abandoning Europe and moving heavily into the electric stack and nearshoring industrial real estate in Mexico. They're doing this to drastically shorten supply chains and insulate themselves from the maritime chaos we talked about earlier.
We are tracking the exact capital flight trajectory here. Money is flowing straight from European commercial centers directly into the industrial zones of Monterrey, Mexico. We're seeing absolutely massive infrastructure commitments, with global auto, aerospace, and semiconductor suppliers locking down millions of square feet of Class A industrial space. It's truly wild to watch.
And listen, this isn't just about cheap labor anymore. Actually, scratch that. It hasn't been about cheap labor for a while. Monterrey's vacancy rates have plummeted to just 12% as global foreign direct investment aggressively re-ranks Mexico as a Tier 1 operations-grade hub. Investors are now strictly filtering for power availability, water security, and US-level tech integration. Properties offering true power certainty, like those with integrated solar microgrids, are fetching massive premium rents right now.
So, bringing it all together, the secret solution isn't just buying high-flying tech stocks, it's owning the physical constraints of tech, silver miners like SILJ, and data center infrastructure like DTCR. When the digital world demands limitless, unconstrained growth, but the physical world has finite, shrinking resources, well, the greatest returns are always going to go to the people who own the bottleneck.
To understand exactly how the no-rules world will impact your local currency, click the explainer on screen now and binge our series on the 2026 commodity supercycle. Because the ultimate question you really have to ask yourself today is this: is your wealth tied to a fading paper illusion, or is it firmly grounded in physical reality?